All right, guys. Jeff here with Fundamentally Smart, and today I wanted to take a break from our stock review series to talk about the Russian invasion or the Russian war in Ukraine and what this could mean to your portfolio and things to look out for. Go ahead and dive right in here. All right, the first and obvious biggest impact has been commodity prices, particularly in the oil and wheat market. So, my first suggestion and the first thing that I would look at is the exposure that I have to different commodities. Do you own a commodities ETF? I think many people think of diversification in their portfolio, but in my experience, it's rare to see an investor actually have commodities exposure. And diversification doesn't just mean exposure to equities, it means exposure to equities, exposure to bonds, exposures to different markets, specifically commodities markets as well. So if you did have some commodity ETFs or some other sort of positive commodity exposure, you're very happy. If you have a lot of exposure to airlines or delivery services or other organizations that have significant exposure to oil markets, natural gas markets, corn and wheat, that could be a cause for concern. So definitely take a look and see where your companies are, what kind of exposure they have to these different commodities that I've got listed here. Um, and from there, we'll go ahead and move forward. Another big factor here is going to be market exposure. What kind of exposure does your organization have not only to the Russian market? Um, these sanctions are going to be incredibly difficult to do business there, as well as there's a big public backlash. I think we saw that in Shell most recently, who decided to keep buying uh, Russian oil and Russian natural gas despite the situation, and they really got a lot of pushback on that. In terms of companies that have significant Russian exposure, Philip Morris, McDonald's, Pepsi, all of those organizations have a good chunk of change, a good chunk of revenue coming from the Russian market. Now, not only is the Russian market at risk here, but also the European market due to the decreased peace and stability in the region. But also, countries like the Netherlands, Germany, Italy have significant exposure to Russian exports, particularly in oil, but in other areas such as metals, such as wheat. And if we see Russia really ratchet up the pressure, we could see, them cut off oil exports. I know that the European Union was looking at reducing their dependency on Russian natural gas and Russian oil. So that could be some cause for concern, despite some of these other companies not having significant Russian markets. And I think a big one to notice here is McDonald's. McDonald's has a big presence in both Russia and Germany, and Germany has a heavy reliance on Russian oil. If Russia does decide to cut off oil or other energy exports, that could be a cause for concern for McDonald's. They don't have a significant dependence on oil themselves, but the German market does. And as oil and other energy prices increase, that could put a strain on McDonald's suppliers, which are in turn going to pass those costs along. Amazon and UPS are another big one. They depend on gas and other factors in delivering their products to customers, both of which have a sizable presence in Germany. Amazon also has a sizable presence in Italy, so they could see some increased costs for delivering their products in those countries. So it's important here to keep in mind not only the Russian exposure, but the exposure that you have to markets that have exposure to Germany, or excuse me, have exposure to Russia. So keep that in mind. Take a look and see what kind of exposure your stocks have to not only the Russian market, but Netherlands, Germany, Italy, and any other country that has a sizable amount of um, imports from Russia. Another thing that's shaken up the markets a little bit is the United States response, particularly whether or not the U.S. is going to enter the war. President Biden has done good job of reassuring the world that the U.S. is not going to enter a war in Ukraine. He has expressly stated that the U.S. would enter a war if Russia attacks a NATO country, and that's still to be seen if that's Russia's ultimate goal. Personally, I think that's a little bit unlikely. I don't think they want a confrontation with NATO. I think that's a big reason why they decided to go into Ukraine, because the pressure from NATO, or the support of Ukraine from NATO, had been indicated that there was not going to be a military response, that there may have been some supplies there. Before I know, before Russia invaded, President Biden had stated we were not going to put troops in Ukraine, regardless of whether or not there was an invasion. And I think that really emboldened Russia to go into Ukraine. However, their ultimate goal really is to be seen, and I think they could continue on into NATO countries, but I think that is rather unlikely. Another point that I haven't seen too much mention of here, but I think is important, is going to be increased regulation at home. I know very recently the president has instructed different federal agencies to look at cryptocurrency, in large part because Russia has been using an increased amount of cryptocurrency to get around some of these sanctions that they've had in the past, and it's yet to be seen whether or not it's going to be used for these sanctions in the future. But I think that's increasingly likely, and I think that's a major decision on why President Biden chose to look at cryptocurrency now over the past. And some of it may not be negative. Some of it might be decreased regulation in the energy markets here, boosting production. President Biden has seemed to stray away from that. He's been looking at other countries: Iran, Saudi Arabia, Venezuela. But I don't think they're going to be able to solve the energy crisis that we're having. So there may need to be some deregulation in that market. Other markets could face increased regulation due to the attention that's currently on Russia. So it's something you'll want to keep an eye on. We've seen it in one or two areas here, but there could be some positives out of some deregulation in different areas. So what does this all mean for your portfolio? Short term, we're going to see a lot more volatility even at this point. Um, I think major events that we could see, when Russia eventually takes Kiev or Kiev. I think it's definitely going to happen. It's just a matter of time. There's only so much resistance that Ukraine can put up. I think that'll be a significant event in the market. Daily volatility has been pretty high as well. We haven't seen that recede all too much. There's been a slight improvement there, but there's definitely going to be increased volatility to come as Russia continues to move through Ukraine. For companies that are exposed to the Russian market or even some of these other European markets, I think we're going to continue to see some big losses booked. That'll show up in the next one or two earnings seasons and potentially forward. And further pressure on inflation. This really could affect the Um, Federal Reserve's attitude towards rate increases, as well as the inflation that we're seeing in the energy markets, could cause further inflation down the line for those exposed. Airlines, delivery services, as I mentioned before, those companies that really rely on oil and natural gas are going to see definitely a crimp on profits, and they're probably going to pass that along onto the consumer as those costs rise. That increase in cost is going to go down onto the consumer. Long term, this is a big destabilization of European peace. This isn't something that we've seen since World War II, really. Um, and that could really change how companies operate there, investments in the region. We could see a big blow to that. This could embolden China. Everybody's talking about it. This could embolden China to go into Taiwan. I think that's a completely different situation and a discussion for another video. Um, but if China does decide to make a similar move into Taiwan, that could really throw off the markets and have a much more major effect than Russia invading Ukraine. Taiwan is a significant producer of semiconductors, and that has really permeated into many more industries than what's at risk for the Russian invasion. And this is a blow to globalization. I mean, there's was a big trend towards globalization, interconnected markets, and these sanctions and removal of business from Russia and Belarus is a blow to globalization. So take a look at your organizations and see what kind of pressure or what kind of reliance on globalization do they have. Because I think this could be a significant um, pushback against globalization moving forward. We might see a reversal in trend. We saw that a little bit under the Trump administration due to their tariffs, and this could be the tipping point that really reverses that process. Where should you look in the meantime? There's always buying opportunities, always. Outside of a nuclear war, there's going to be some companies that are profiting from this, and you could take advantage of that. And I think one of those areas to be looking is companies with significant American exposure, companies who source and produce in America. We're going to be relatively insulated to the conflict here. The European markets, not so much. So companies who are buying and sourcing here could be a significant benefit. One that immediately comes to mind is Honda. Honda has significant sourcing of American products that go into their car, as well as multiple plants here in the U.S. They do not have any Russian plants, and they that could represent a big benefit to them. Now they do export a small number of cars to Russia, and that will be some difficulty there. But other than that, I think they're going to be really strong due to their American presence, um, especially if there is further conflict in Europe or energy prices do continue to rise in those countries like Netherlands and Germany. Um, Face significant trouble getting oil and such into their market. The American car industry is very strong right now. There continues to be significant demand there, and I don't see any slowdown due to any of these conflicts. Other than that, Tesla, another car company, they have significant American operations. They do have exposure to Germany, so there is some concern there. However, that American component will be really strong. Take a look at your company, see how much of their business is here in America, how much is produced and sourced here in America. Whether it's a service based organization and they're giving a lot of services here in America, or it's a manufacturing and sales company here with domestic operations. Um, Tread lightly when it comes to companies with significant exposure to the Russian and European markets, and just take a look at all of these different factors that I have previously mentioned. Good luck. If you have any questions, drop them down in the comments. Be sure to like and subscribe, and have a wonderful rest of your day.